Hey guys, welcome back. This is the complete Apple trading playbook, the chart, the setups that fit it, and the exact levels you trade. Here is the last 4 months of Apple on one chart, and it tells you exactly what kind of stock you are trading. This is not a wild ride, it is a steady leader. From a spring low near 245, the stock grinds higher for weeks, and every dip gets bought. Then it breaks out in May, clears a ceiling that had capped it for half a year, and runs all the way to a brand new record, 317. Then in 2 days it snaps back down, giving a chunk of that record run straight back. And look where the selling stopped, this teal band, right where the buyers stepped in. Remember that level, because the entire plan at the end of this video is built on it. Price is sitting right on that band. This video gives you the full playbook for a leader like this, how to read it, the 3 setups that actually pay on it, the 1 trap that wrecks accounts, and the exact trade plan. Let's start with the numbers. Before you trade any stock, know the stock. Apple is worth about $4.3 trillion, the single largest company on the planet. Over a 12-month run, it climbed more than 60% off its low to a fresh record, and through almost all of it, it beat the market. This is a leader. Now the numbers that change how you trade it. And here Apple is the opposite of a meme stock. In a normal day, it moves only about 2%. Calm, about a quarter of what a stock like Tesla does. So here your edge is not dodging chaos. Your edge is patience and position size. Liquidity is never your problem. About $15 billion of Apple changes hands every single day. And the gap number is friendly too. Only about 1 morning in 9 opens a full % or more away from where it closed. A calmer stock means your stops actually behave. But earnings still hit 4 times a year. The next one lands July 30th, and every level in this video resets that night. What actually moves it? The phone and the product cycle, the services business and its margins, and the buybacks and guidance. Know the stock. Now let's read its chart. Reading any stock starts the same way, zoom all the way out. This is a full year of Apple, 1 candle per week. And it is the opposite of a wild stock. It is a clean staircase up. From a summer base near 195, the stock climbs all year, makes higher high after higher high, and prints a brand new record at 317. That is a real uptrend, an escalator, not a roller coaster. But the secret is not the highs, it is the floors. Look at the dips. The winter pullback bottomed near 243. The spring dip bottomed near 246, a touch higher. And the June flush held a higher low than the spring again. Every single pullback stops at a higher floor than the last. That is buyers in control. That is what a leader looks like. So the tide rule for Apple is the exact opposite of a wild stock. The weekly is a clean uptrend. You trade with the trend, you buy the pullbacks to rising support, you take profit into strength, and you never short a leader. Now zoom into the daily. Now the daily chart, where the decisions happen. And check the dates along the bottom, February through June. Box 1 you already have, the weekly says uptrend, so the bias is to buy dips, not to short. Box 2, structure, who is in control. For most of the spring, Apple sat in a quiet range floor near 245, the same ceiling near 276, rejecting it again and again. Then in May, 1 big candle breaks the ceiling, and from there it is textbook strength, a clean higher high, then another, all the way to the record. Buyers are in control, plain and simple. Box 3, volume, the bars filling in along the bottom, and here Apple tells you who did the work. The loudest buying day of this whole stretch was the breakout itself. 80 million shares pushing through the ceiling. But watch the other end, the loudest selling day was the record. 70 million shares dumping at the top. Buyers at the breakout, sellers at the record. That is the whole move in 2 bars. Box 4, the white line crossing the chart is the S&P 500 on the same scale. And this is where Apple earns the word leader. Since February, it stays above the market line almost the entire way. It leads on the way up, it leads off the bottom. A leader you buy on its dips. You never short it, and you never fight it. 4 boxes read, 1 to go, and on a leader like this, the levels decide the entry. Box 5. The levels. Forget every squiggle on this chart except 3 prices. Check the dates, this is just a 7-week window. Price number 1, overhead the supply band, this red zone, roughly 312 to 317. That is the record. And the 2 days of heavy selling that came off it. Until price reclaims that, the record is a ceiling, not a target. Price number 2, the trigger. 297, the high of the bounce since the flush. As long as Apple lives below that gold line, the pullback is still in charge. The day it closes back above, the dip is over. And price number 3, right underneath us, the support shelf, roughly 287 to 291. When the record run snapped back, that is exactly where the buyer stepped in and stopped it dead in this band, twice. It lines up with the breakout level underneath it, and the rising trend. That is real support. The supply above, the trigger in the middle, the support shelf below, 3 prices, 1 battlefield. Price is parked just above the shelf, sitting right on it. Time to meet the 3 traders who run this playbook. 3 traders are going to run this exact stock across 8 months of trading, each starting with $10,000. First, this is Mike. He trades only the 3 setups in this playbook, stop and target written down before he clicks buy. Next, this is Jake. He calls bottoms, he chases records, he sizes up when he is sure, and he is always sure. And finally, this is Tom. He waits for proof. By the time a move convinces him, the discount is gone. Same stock, same starting money. Watch what the entry alone does. Setup number 1, the anchored volume weighted average, and this is how the institutions actually buy a leader. Start at the October low, the exact bottom of that flush. Anchor a volume weighted average right there and you get this rising line. The true average price every buyer has paid since the bottom. That is the big money's cost basis and they defend it. Jake has no such line. He catches the knife on the way down, buying the flush with no level underneath, and dumps it days later near the low, $300 gone. No anchor, no plan, no edge. Now watch the line do the work. Through November the stock pulls back, and look where it stops. For 5 straight days price rides this anchored line, tagging it, holding it, refusing to close below. That is institutional support you can see in real time. Mike does not guess the bottom. He waits for the line to hold, then buys the reclaim at 271. His stop sits just below the line, near 263. If they lose their own cost basis, he is out. His target the prior highs, 285. The line holds and the trend resumes. Tom, as always, ignores the line and buys late near the breakout, 283. And the first red day shakes him out for 200. Then in early December Apple tags the target, $900 for Mike on 500 risk. The anchored line is the trade. It shows you exactly where the institutions are defending, so you buy with them, not against them. That is not a moving average guess. That is following the money. 1 setup in, and the scoreboard already tells the story. Buying with the institutions paid Mike $900. The falling knife cost Jake $300, and the bounce he missed while licking that wound cost him far more. Tom paid $200 for chasing the breakout late. Setup number 2, the liquidity sweep, and once you see this you cannot unsee it. Rewind to the spring. For weeks Apple has an obvious floor near 248. Everyone can see it, which means everyone's stop loss sits just below it. That pile of stops is a magnet for smart money, and Jake walks right into it. He is sure the obvious floor will hold, so he buys it early on margin, stop just below, exactly where everyone else put theirs. Then the market does what it loves to do. It spikes straight through the floor, down to 245.5, triggering every stop in the pile, Jake's included. He sells into the very low, $1,000 gone. But here is the tell. Price does not stay down. The same day it reverses, and the next day a big green candle closes right back above the floor. That is the sweep. The stops got run, the weak hands got flushed, and the real buyers stepped in. The break below support was not weakness, it was the trap. So Mike waits for that reclaim and buys the close back inside, 254. His stop goes under the sweep low, 244, below where the trap already printed. His target the top of the range, 270. Tom, predictably, ignores all of it and buys late and too high. And one more wick toward the low shakes him out for 200, while the sweep low holds to the cent. 3 weeks later price reaches the target. $800 for Mike on 500 risk. When an obvious level breaks and instantly reclaims, that was not a breakdown. That was a stop run. You buy the reclaim, not the break. 2 setups in, and the gap is widening. Mike's stop run reclaim banked another 800. Jake's margin bet on the obvious floor cost him a full 1,000. His stop was the very liquidity they came for. And Tom keeps donating 200 at a time for arriving late. Setup number 3. The order block, the institutional version of a breakout retest. For half a year, one ceiling near 280 capped the stock every single time it got close. Then on the 1st of May, a giant green candle smashes through it on the heaviest buying of the spring, 80 million shares. That kind of violence is the footprint of institutions, and the level they broke out from becomes an order block, old supply, now demand, and Jake just chases the candle, buying near the top of it, no stop because up is up, but breakouts punish chasers. Mike does the opposite. He does not chase. He places a resting buy order back at the order block 280 because price almost always returns to mitigate these zones before it runs. 3 days later the return comes. Price drops back into the block, slips to 274 and change, and fills his resting order without him lifting a finger. His stop sits just under that retest low. And here is the beautiful part. Price bottomed a hair above his stop, 86 cents, and turned right where the big money defends. Meanwhile Jake, watching his chase go red, sells it in disgust at 276, the exact level Mike just bought. And look at the geometry. The stop is tiny, $6 under the block. while the target is the open air above, near 305, 4 times his risk. The next green day Tom buys the reclaim at full price, rides it 2 days, and pockets a little $80 at the first wobble. Then the institutions run it. Price tears through the target near 305, $1,300 for Mike on 300 risked, on the very dip that cost Jake 600. The order block is the trade. The breakout is just the advertisement. After the order block trade, the scoreboard is brutal. Mike is up 30% on 3 clean clicks and a lot of patience. Jake is down 19, every loss the same shape, right direction, no level, no stop. Tom is still grinding out crumbs. 1 chapter left, and it is the expensive one. And now the trap. The one habit that empties more accounts than anything else, even on a great stock chasing the record. It is early June. Apple has gone nearly straight up into a brand new all-time high, and the headlines are everywhere. Biggest company on earth. Fresh record, the only stock that goes up, it feels safe. It is the opposite of safe, and Jake cannot stand it anymore. Everyone on his feed is up. He goes all in, chasing it near 307, on margin, no stop. It is Apple at a record. What could go wrong? Mike runs his checklist instead. Is this a sweep reclaim? No. Price is at a record, not reclaiming anything. Is this a return into an order block? Nothing was breaking. Is the anchored line holding? Price is extended miles above it. Above a record there is no level overhead, which means no defined risk. And no defined risk means no trade. 3 questions, 3 naws. He sits on his hands, and even Tom stays out, not from discipline, he simply cannot click fast enough. For once, slowness finally pays. Then the stock prints the record and turns. There is no scandal, no disaster. The buyers simply ran out at the top, and the sellers you saw on the volume chart take over. In 2 days Apple gives it all back, an 8% flush, and Jake, staring at a loss he swore could not happen, waves the white flag near 290. $2,000 in 2 days on the best headlines of the year. For Mike, skipping it cost him nothing, and watch where the panic lands. Inside the same teal support that sits just under price. Records get sold. Dips to support get bought. The chart never changed, only the crowd did. If you missed the run, you missed it. Wait for the stock to come back to your levels. So here's the payoff. The exact map as of the June 12th close. Nothing on this chart is hidden, and every level comes from candles you have already seen. Price closed near 291, standing right on support. The 287 to 291 band where buyers stopped the record flush and bounced off it twice. That band below us is the line in the sand. Far above, the supply band where the record sellers live, 312 to 317. And between them, one line 297, the high of the bounce. That is the trigger. Plan A is the reclaim. If Apple prints a daily close above 297, the pullback is over and buyers are back in charge. Entry on that close. Stop under 287, just beneath the flush low. If the reclaim is real, support holds. First target the pre-crash highs near 311 with the record beyond it. Better than 2 to 1, a clean base hit, and you take it. Plan B is the exit signal. If a daily close lands below support, below 287, the floor that caught the flush is gone, and the dip becomes a deeper correction. That is not a shorting invitation on a leader. It is a stand aside and wait signal. No longs until price finds the breakout floor near 280 and builds a new base. And so far, neither has happened yet. Price sits between support and the trigger, so the playbook says the hardest thing in trading nothing. These are scenarios, not predictions. We react to closes. The market goes first, then we act. And remember, earnings on July 30th resets this entire map. One more thing before you go, the 4 rules that make this stock tradable. Here is the whole 8 months on one screen. Mike finished up 30%. The anchored line paid him first, the liquidity sweep came next, and the order block paid him the most. And the one setup he refused, the chase at the record, is the only red mark on this screen. Skipping it cost him nothing. Jake finished down almost 40%. And here is the uncomfortable part, he was never really wrong about direction. His sweep bottom in March was the right idea with the wrong entry. His record buy was right about the trend, nearly right, every single time, with no level and no stop. That is the most expensive way to trade there is. And Tom, 8 months, 4 decisions, minus $320. He paid full price for every proof and got shaken out of every wobble. 8 months for so little. Same stock, same screen. The entry was the edge, and the trade you refuse is half of it. Your whole Apple playbook fits on one screen. Rule 1, rid the tide. The weekly says uptrend, not range. Trade with the trend, buy the dips, and never short a leader. Rule 2, map the 3 prices, the supply band overhead, the trigger in between, the support shelf underneath. Price only means something at those. Rule 3, wait for a real setup. Only 3 institutional entries exist in this playbook: the hold of the anchored line, the reclaim after a liquidity sweep, and the return into an order block. If it is not one of those three, it is not a trade. And rule 4, never chase the record. A brand new high with no level above it is not a setup. Miss the move, shrug, and wait for the dip to your prices. Buy Apple at your levels, or let it go without you. That is the complete Apple playbook. How it trends, the 3 setups that fit it, the 1 trap that does not, and the exact map from the June 12th close. The levels expire earnings on July 30th redraws everything, so recheck the map before you act. And the obvious part, said plainly, this is education, not financial advice. Never risk money you cannot afford to lose. Coming up next, the Microsoft playbook. Subscribe so you don't miss it, and tell me in the comments which stock you want broken down after that. See you in the next one.